This is part two of me being exposed as a charlatan. In part one, I hope I was not too harsh on Graham. If you did not see part one, you can go back, or maybe I got in trouble and had to remove it. But let me just briefly cover what was in part one. Essentially, there are many who believe that market timing is some kind of fantasy and that the safest and most profitable way to invest is to buy and hold. We've even heard this from Warren Buffett. But if that is true, why is Warren sitting on more than $100 billion? Well, Warren cannot find anything to buy because stocks are too expensive. He's even said so. Now, he may add to some existing holdings, but isn't continuing to hold on to $100 billion over 2 years, isn't that market timing? I think so. Well, we've also heard that time in the market beats timing the market. And this kind of statement is parroted by many without much thought. It is actually a myth perpetuated by Wall Street to get your money. Today, buy and hold is more like hope and pray. So first we're going to hear more from Graham. Then we're going to look at a few examples of timing the market that blow away buy and hold. So let's go.
Best investment strategy again out there is simply buy and hold long term. And one last note before I finish up this video is that it's very true what they say that time in the market beats timing the market. Now consider this. If you've invested in the S&P 500 over the last 10 years, your return would be approximately 7.2% annually. If you missed out on just the top 5 trading days over the last 10 years, your return would drop to just over 5%. Then if you miss the best 10 days of trading over the last 10 years, your return would only be 3.5%. If you ended up missing the top 20 days over the last 10 years, your return would only be 1.15%. And if you missed the top 40 days of trading over the last 10 years, your return would actually be negative 2.8%. Remember, this is over 10 years. We're talking about just missing a few of the best days over 10 years. That's how impactful it is that time in the market is almost always better than timing the market.
I have several issues with the theory of buy and hold, but the most obvious is that investors do not necessarily have a long time. Given that most investors do not start seriously saving for retirement until about the age of 35 or older, most investors have just one market cycle to reach their goals. If that cycle happens to include a 10 to 15 year period in which total returns are flat, the odds of achieving their savings goals are massively diminished. If an investor's 30-year investment cycle happens to end with a major crash, the result could be devastating. Time duration and ending dates are critically important to expected investor outcomes, and you don't hear them talk about that. They'll pick a stated time frame to fit or justify their conclusions. Secondly, buy and hold theory fails to consider risks, expected returns, and alternative strategies. Consider that from the year 2000 through 2013, the S&P 500 index, including dividends and inflation, delivered a zero rate of return. And from the year 2000 through the year 2017, it returned a scant 0.3% more than risk-free treasury bonds. You would have realized the 5.4% annualized for stocks versus 5.1% annualized for bonds. Further, to reach that return, it required the expansion of valuation multiples to extreme and risky levels. Equity investors have endured two 50% drawdowns and over a decade of no returns to achieve an 18-year, 30 basis point annualized pickup over bonds. And that is not anything to crow about. Even Dow theory beats buy and hold. Now, because I've already done a video on Dow theory, we're not going to talk about it here today. Instead, I'm going to give you just two simple examples of timing the market that will beat a buy and hold strategy. So let's take a look. Many market participants are obsessed with predicting the market direction because the payoff can be tremendous if the right bets are placed at the right time. One reason that there is so much focus on market timing is that stocks have a tendency to move in a correlated fashion. It has been estimated that roughly 80% of stocks will move in the same direction as the indices. Good market timing can help to put the wind at your back when trading. It is always easier to trade with the overall trend, and if you are confident in market direction, you can be more aggressive at buying or do a better job of playing defense. Some market commentators claim that accurate market timing is not possible. While it is true that no one has ever accurately called all the twists and turns in the market over a long period of time, there are plenty of examples where reacting to changes in trend have made an extraordinary impact on investing results. My way to time the market is to use charts. In my opinion, this is by far the most effective way to approach the market timing, but there is a tendency to make it far more complicated than it should be. The problem is that market timers always want to make their calls at the exact moment that the market hits a turning point. When you try too hard to be precise, the risk of error increases greatly. The only way to be extremely accurate is to be early. You can't call an exact top or bottom after the fact, so you will miss out on the glory of a great call, but you also miss out on endless premature predictions. In the last 25 years, there have been two major bear markets. If you avoid the bulk of these bear markets, you have likely produced superior returns. The key to avoiding them was to simply watch the trend lines, and when they were broken, to move out of the way. There is no question that you will suffer some losses if you wait for a trend break to actually occur, but the benefit of staying in the market as a trend continues longer than is expected should help offset the damage. It is always easier in the rearview mirror, but this chart here of the S&P 500 shows how trend lines are a key to market timing. Now this is different than my oscillators, but the idea is the same. So now let's go see another related method. And this information and chart here is from Advisor Perspectives. So buying and selling based on a moving average of monthly closes can be an effective strategy for managing the risk of severe loss from the major bear markets. In essence, when the monthly close of the index is above the moving average value, you hold the index. When the index closes below, you move to cash. The disadvantage is that it never gets you out at the top or back in at the bottom. It can also produce the occasional whipsaw of a short-term buy or sell signal, which we've seen a lot since, say, 2016. Nevertheless, the chart here of the S&P 500 monthly closes since 1995 shows that either a 10 or 12-month simple moving average strategy would have ensured participation in most of the upside price movement while dramatically reducing the losses. And as you can see here, the green dots are when you stay in the market on the way up, and the red dots are when you move to cash. And again, this is the 12-month simple moving average, but it can be done with others like a 10-month simple moving average. But as you can see, the signal to move in or out is very simple. And this simple strategy blows away buy and hold. So for today, that's ChewDog the Charlatan. We'll see you next time. Thank you.